Welcome to Orange County Power Players, where we spotlight the personal, professional, and financial success stories of OC's top leaders. Here's your host, Danny Flores.
Welcome back to OC Power Players, where I interview some of the most successful people in Orange County. I'm Danny Flores, your host, and today's honored guest is Brian Ferguson, zooming in from Victoria, Texas. Since he started his real estate career, Brian has been passionate about expanding his knowledge and sharing it with others to help them achieve true financial freedom. With 16 years of real estate investing experience, before ever raising a dollar outside capital, Brian realized he could help others grow their wealth through syndications. He has been doing so ever since. Welcome, Brian.
Hey, man. Thanks for having me.
Sure. So tell us a little bit about what you do.
Yeah, kind of started, we're going to 18, it'll be 19 years this year. Started in the single family world, kind of fix and flip, single family investments. And then, we started in 06, 07, so not the greatest time to start. And that kind of transposed into us holding some single family and then eventually building a large single family rental portfolio, got into some land development, ground up construction. Fast forward that, we still have our single family division this year. That's our investment leg. And then right now we're mainly focused on larger multifamily and retail and professional shopping centers. So is what we're doing in 2025. But that's the short version.
Wow, yeah, that's quite a transition there. When did you make the jump? Like, how long have you been doing the multifamily and retail?
So like I said, from that 05, 06, 07, there was houses that just wouldn't sell when the market went down, and we held on to them. Then over time, we got, some duplexes, fourplexes, 16plex. Then you fast forward to those mid-teens, kind of 15, 16 year market tick back up. We started selling off houses, 1031ing, buying some, 20, 30, 40 plexes. And then say 18, we jumped into our first 100+ size unit deal. We really love that. We continued buying some stuff and then some smaller shopping centers. And then we really found a love for that when apartments got really tight in that 2020, 21. We shifted a lot of focus to the shopping centers, the retail centers. And then when we started syndication, that's when we started going after some of the larger centers and apartment complexes. And so that's kind of how that transitioned. And then just in the past few years, we're still heavy in multifamily, but we've done really well in the retail centers. We have a pretty good niche for it. So we're focusing a lot of our time in that space.
So you guys are you guys still buying retail centers right now?
Yep, we actually closed in one in Katy, Texas, the last day of January. So that was our last acquisition.
Wow, congratulations on that. So now what is the difference so our audience can understand the difference between doing an acquisition in a retail center versus multifamily?
So there's a couple different things. From an acquisition standpoint, one thing is there is a lot of, your agency style debt, Fannie Mae, Freddie Mac, underwriting's a little bit easier. While some of their requirements may be a little bit steeper than a conventional bank, getting to the finish line is a little bit easier on, being able to guarantee, or them not requiring a guarantee, things like that. So the space is a little bit more limited because it's a little bit harder to acquire the debt for the shopping centers. And then how you manage it's completely different too. Like property management, we have two different we own our property management company, but it's two different legs. It's split on how they operate. Just how you operate, how you lease them is very different. So the acquisition piece is different, and so is the how you manage it. I'll also say a lot of the apartments you look at are some syndication group putting it on the market, being bought by another syndication group. You see a lot of that. You still see some individual owners, but there's more of, whereas in the retail side, it's larger investment companies, and you're just not, it's a very different space. Your contacts are different. How you find them is very different.
So now what's the difference in returns? I imagine you syndicate both, correct?
We have syndicated both. Yes.
So just so that everybody understands, Can you explain what a syndication is and how you put the money together for the equity on these acquisitions?
Yeah, so a syndication in a sense is pooling money together from friends, family, or other investors. We refer to them as limited partners or passive investors. So if you're buying something for 10 million bucks, and let's say you need to raise 3 million between down payment and whatever your capital improvements or remodel plan is, you raise that 3 million, you go to a bunch of people that all want to put in 50, 100,000, 200,000 a piece. We act as the general partner in the deal. So we manage the asset, we run the day to day, we get a stake of ownership for doing all those things. And then the passive investors, based on what terms were agreed on, they're just that, they're passive, they don't do anything. And when the property does well and cash flows or we sell it, they benefit there. So we also act as a general partner or the sponsor of the deal. And then in all of our deals, we're also investors on the other side. We put our own money in as well. So that's kind of the reason we did it. We wanted to scale into these larger projects, but if we did one by ourselves, then it would have to wait so long to build up the money to do the next one. Now we can put a little bit in each deal. We normally put about 10% of the deal in and then pool it with other people's money, and we can do more. And there's a ton of efficiencies of scale when it comes to that.
Now, what's the return difference between multifamily and retail when you put these projects together?
So like for a vacancy, for instance, you can do a make ready and, fill it in 2 weeks. We normally underwrite the commercial aspects with a minimal of 6 months vacancy per turn. A lot of times we underwrite to the 9 or 12, simply because it takes so many months to find a tenant, and then you're normally giving, 6 months of concessions. Most of our stuff now we're dealing with, all of our stuff now we're buying, their full triple net, which triple net means so taxes, insurance, common area expenses, cutting the grass, light bill for the parking lot lights, that all gets passed back through. So it's very different, that aspect, where you may have rubs on a multifamily and you get some of the water paid back to you, but cutting the grass and things like that are considered, they're a pure expense to your P&L. Whereas on a triple net center, every dime we spend is completely recovered from the tenant. So
does that make the returns to the investor higher in retail versus multifamily?
I get asked that a lot. My answer to that would always be on how did you underwrite the deal? It should not, right? If you want to underwrite a deal to be a 8% cash on cash for the investor, it shouldn't matter. If that's how you underwrote it and you did the right due diligence, that's where you should end up, right? Unless you had some issues. But I will say in the past few years, that has been the case for us. Just, the taxes and insurance, you can only control to a certain extent. And, anybody that's been doing this a substantial amount of time knows that the increases in taxes and insurance the past few years are much higher than we've traditionally seen. So we underwrote based on historical. And let's say you underwrote at a 3.5 or a 4% increase on that insurance policy, and then it went up 15%. Now we know to underwrite to that higher number, but we didn't then. Right. That being said, devil's advocate, and a caveat to that is, just because you can pass it through doesn't mean you'll collect it at that same time. When insurance jumped, one of our larger centers, we had a tenant that had been there about 7 years, just a owner operator. He was, kind of working all the shifts. So he wasn't really, making a whole bunch on this location or in this business he had. Well, when taxes went up and we had to pass through and get our recoveries at the beginning of the year and raise his rate, he skipped on us. So just because the lease says they can recover, if it goes up too high and they leave, it doesn't matter. So you still got to be very diligent in making sure you minimize those increases.
Now, are all the acquisitions that you're doing in Texas?
Yes, everything we're doing is in Texas.
Okay. Now, can you explain what the property taxes look like there in the projects that you do? Because we understand they're kind of all over the place, right? They can reassess every year, I believe.
Yes. Yeah. So they assess every year. I don't know the exact months, but normally we'll start getting some statements. I think it's that May, June, that summertime, on what the proposed assessment is, or maybe it's a little bit earlier, April, May. And then you have so many months to dispute it. If you're a larger company, or you have, a handful of properties, we normally bring in a company to handle all the disputes. So they'll dispute, they'll go to a board. If that doesn't get solved, we'll go to arbitration. We still have some properties from last year that we're still arbitrating now. And then some of them may even go to a lawsuit. We've been in lawsuits where we've sued the county before and we won some of them. So But yeah, that's an annual deal. Tax rates, are somewhere in that 1.9 to, high 2% range is what you'll normally see. It's just, and the
That's
tax,
of the assessed value, right? So they can come
absolutely.
back and say, guess what? Your building went up 5 million this year. You're paying 2% of that this year. You're like, wait a minute, that's not the case.
Correct. Yeah, correct. Yeah, famous, we've said plenty of times, write me a check for it then,
Right.
if it's worth that, write me a check. It's the county can own it. But yeah, and the rate, actually we've seen specifically in like Victoria County, we've seen the rate go down a little bit over the past few years, but the values, and I think that's how they tricked you. That they pitch this, the rate's going down, but then the values, so the rate goes down, say 10%, but then the values double. Well, don't got to be a mathematician to know that that doesn't work.
Right. So that's probably all the landowners, and maybe in Texas have like an army of a team to fight every year. You guys got to fight the battle of no, that's not the correct assessment of the valuation, and we're not going to pay these big tax increases, and you have to get in there and fight that, right, and get that reduced.
Yeah, absolutely. So there's like, there'll be local folks that do it and they'll represent like let's say you're disputing your house or, a couple rental properties or commercial property, there's a local group that, that'll do it most places where you're at, I would assume. We had someone internally that did it for us for years. That was mainly her job, was sourcing insurance, disputing values. But then it just got to a certain point where we source a company, and normally, they'll charge you 25% up to 30%, kind of based on when they win, how far they have to go with it. It's somewhere between that 20 to 30% of every dollar they save. So even if, to your point, it went up 5 million, 2%, so it's $100,000 in tax value. Let's say they 100% win and get the value back to where it was, still cost you 20 to 30 grand to get it there.
Right.
So, and again, on triple net, I can pass that back through that fee.
Right.
But apartments, so they won the value, right? It's a 100-unit complex, and
Right.
they had to arbitrate it. So that's $30,000. We'll divide that into a per door. And if I can't increase the units, that per door rate, then I immediately lost money that year.
Yeah. And that's the unknown, right? When you're buying apartment buildings, that you're not going to know what's going to happen there.
Yep. Absolutely.
So maybe retail is a little bit more attractive because of that. It doesn't really take out of your operating expenses. You're able to pass it back to the tenants.
When the deal works out well, what's the advantage where you'll see a lot of the apartment or multifamily working well is, they're 12-month leases in that 5 years. So we get deals come across our desk. They're going in cap of, like normally if a good multifamily that's been operated by a solid operator comes across our desk right now at a going in cap at, let's say 7.5%, that's probably going to be, if the rates aren't maxed out, there's probably going to be a pretty good opportunity to make a lot of leeway on that deal over a 5-year period. Go in, do a little bit of work, increase the rates, $100 a door, get some bumps on there. On a commercial deal, let's say they are under rented, but let's say they have 5 and 7 year locked leases. We see this a lot with some like individual landlords. They did these 5 and 7 year leases where there's no rent increases. So it's going in at, say, a 7.5 cap. But by the time you borrow on it and put the debt on it, there's just not enough to give those investors the returns because there's no really value add play there at all. They're locked in for 5 to 7 years. So that's the big difference there. You can, if it's 150 units, you can normally churn half of those units with an increase within 6 months or 9 months.
Right.
The leases are much longer on the commercials. So for it to work for us, for instance, we normally we want something that has, 10, 20% vacancy. And we prefer a little bit higher vacancy. That way we have the opportunity to value add that with some, additional income.
And how about vintage? Is there a vintage that you don't go past and you like to keep it newer?
Yeah, apartments, not necessarily. That Victoria, Texas market is huge for us. We own a large portion of it, got about 1,000 doors there. We'll look at, the 80s, 90s stuff. On shopping centers or the retail centers now, retail or professional, we like to be 2,000 or above center. We have some parameters, 2,000 or above. We don't want, one tenant, occupying more than a certain percentage of the space. We don't want food industry to be over a certain percentage of the space. So if you had asked me that 3 years ago, I'd have been like, I mean, if it underwrites, we're buying it. Our buy box for 25 is very tight.
Yes, good, good. So there's other operators such as yourselves that do the same thing. If an investor is looking to invest money with you guys, what's the difference between you and other operators that would make you more attractive to an investor?
I would say the biggest difference is our years of operational experience. We started from single family, got into multi, got into commercial, but I'll give you an example. So last year we weren't in a heavy acquisition mode, especially on the multifamily stuff. Taxes went up, insurance went up, like we just said. I couldn't raise the rates to offset that. A lot of people would have just gone out and said, okay, well, that asset's not going to work real great. Let me go put a bunch of other deals together, make a bunch of fees on these. That's not our approach. We had the experience to go and say, okay, let's go to these manufacturers. Let's start buying direct from the manufacturer. Let's buy HVAC units in bulk. Let's warehouse them, bring that cost down. Where can we share resources between, say, these two complexes that are next to each other? Do they need, we took a complex where, like, do they really need this many staff, or could they share the porter? So we did that and split their hours between there. That saved us a certain percentage. So the operational experience, because I've met so many guys that we've talked about partnering, and they've been doing this, say, 3-4 years, but their main job was somewhere else. Some of them, their main job is still somewhere else, which there's nothing against that. I commend them for that, but we're in this every day, all day, 50, 80 hours a week.
Right.
And we did this before we raised a dime of anyone's money, when it was our money. And I treat investors' money at a higher level. And everyone on my team, ask anyone on my team, if it's investors' money, protect that harder than our own.
Right. No, that's good to know for the investors to know that. And yes, operational efficiencies can reduce operating costs and help produce the type of returns that you guys want to produce for the investors. Now, what comes easier for you guys as a company that others might struggle?
Surrounding ourselves with a good team is something we're really big on, and just really being fine-tuned on the operations. Me personally, the financials, making sure the financials are dialed in. That's my strong suit. Math and people are kind of my two strong suits. A lot of guys that do what we do are really good at the capital raising. That's not our strong suit. We find a deal. We know how to put the deals together. We know how to operate a deal and make them profitable. You have to have the money to put those deals together at scale. So that is a task for me every time. I'm like, oh man, I got to schedule and talk to everyone. Once I'm doing it, I enjoy doing it, but it is not second nature to me. But there's guys that can do that a lot easier than I can.
It's like a different gear in your car, right? You got to shift gears, and it's totally different
Absolutely.
approach. Yeah. So what's been one of the biggest challenges have you had to overcome in your career?
Man, there's probably a handful of them. I would say one thing that was huge for us to overcome and really get past was the mentality, whether it be from who we hire or partners we make, just getting past the mental block that, I can do I can do everything myself, or I selfishly want everything for myself. So once I learned to surround myself with people that are better than me and wherever my low points are, and when I learned that, 20 or 30% of something with a bunch of partners is better than 0% of a deal I couldn't put together. It took me many years to learn to work through that. And that was a big struggle. And we still struggle with it now, but we've gotten so much better, and we have the right team. And that's been one of our biggest blessings.
So some investors, as they look to put their portfolio together, it's usually a good idea to have diversification, maybe some securities, stocks, and some real estate as well. And then at the same time, they're building up additional passive income to potentially set themselves up for retirement. What are your thoughts on that?
Like on the diversification advice, you mean, or?
Diversification, investment, coming in passively, just to, maybe they, like you said earlier, they might have a regular job, but maybe they want to have additional source of income. When you build multiple streams of income, and this could be one of them.
Yeah. So, one, between stock market and investment, most of our investors are in both. I definitely, there's advantages on both sides. I'm not a big stock market guy. I'm a real estate guy, but when you're looking to, my thought is if you're planning on putting all your money in this, or if you're currently a stock market person, then investing passively in real estate is a great diversification piece, right? Now, if you get someone that wants to be active and they want to be hands-on and buy a rent house, well, then that's a whole different thing. And by all means, go buy the rent house. I could talk to you for hours on why that's probably not the best long-term goal, but whatever, if that's where you want to start. My thing is, I think you have much more if you can, when you put your money in, you can trust your financial advisor, but they're still hedging a bet. And to me, a financial advisor is hedging. Now, if you give your money to me and invest it, I'm still hedging a bet. But my underwriting and my historical data on knowing if that center or those apartments are going to be successful is, I feel, stronger than, a stockbroker on where he's placing the money. So if you trust the jockey that's riding that horse and, they know what they're doing, I think syndication is a great option. Not only do I invest in my own deals, I invest in other syndicators' deals. I'm diversified in that sense in other markets that I like that, hey, I don't want to go buy the property and be the operator there, even though I'm an operator over here. But I like the market. I think it's a good deal and I'm going to sink some money in it. So I think it's a great diversification. There's some great tax benefits, which that'd be a whole nother story, but there's definitely some tax benefits versus putting your money into you can make money, have great cash flow in a year from real estate investment and still have, tax benefits that you may not see in stock. So again, that'd be ask your tax professional, but there's a lot of benefits for it.
Right. No, that sounds very attractive. And as we get ready to wrap up our interview, what exciting plans do you have for 2025?
So again, like I said, we dialed in our buy box. We already did our expansion into the Katy market. So we're looking at a lot of deals in the sub areas of Houston, not Houston specifically, but Katy, Texas. We looked at the deal in Cypress. We're looking at Sugar Land. Katy Sugar Land's a big area. We really love that. But so that alone is pretty exciting for us as we transition into that area. And our goal is to, we have a certain number that we're trying to add in assets, and that's our goal for 25 and, as well as being in the new market.
Well, Brian, thanks so much for sharing the tips and insight in syndication investments in multifamily and retail. Now, if somebody wanted to get a hold of you, how could they do that?
Yeah, so our company name, fergmar.com, fergmar.com is our main company website. And then fergmarcapital.com is for our capital side if you're looking for investing. But you can drop to the main site and there's a lot of options about everything we do. And then if you want to contact me directly, it's bferguson@fergmar.com. That's my direct email. You can find me on LinkedIn and Facebook as well.
Very good. Thanks so much for coming on, Brian. And to our followers, please go to OC Power Players and follow us on your favorite channel, and don't forget to like us.
Thanks for listening to Orange County Power Players. Want to share your success story? Apply to be a guest at ocpowerplayers.com/guest.